Breaking. A major shift in global energy flows is unfolding right now, and its effects are already being felt by consumers. Canada and China have moved forward with a new oil redirection arrangement that is changing where energy supplies are going and how fast prices are moving. Overnight, gas prices in parts of the United States have spiked, catching markets and drivers off guard. Officials have confirmed that large volumes of Canadian oil, previously bound for U.S. refineries, are now being redirected toward Asian markets, with China emerging as a key destination. This change follows new long-term supply agreements and shipping adjustments that were finalized quietly and then activated rapidly. The shift is not symbolic. It involves real barrels, real tankers, and real changes to daily supply routes. Canada is one of the largest oil exporters in the world, and the United States has long been its primary customer. Pipelines, rail networks, and refining systems were built around this relationship. When even a portion of that oil is diverted elsewhere, the effects move quickly through the system. Refineries must compete for alternative supplies, transport costs rise, and prices respond almost immediately. China's role in this development is central. As the world's largest energy importer, China has been expanding efforts to secure stable long-term supply. The new arrangements with Canada provide diversification away from other sources and reduce exposure to disruptions in different regions. From China's perspective, locking in supply now is about future security, not short-term price movements. Energy traders reacted within hours. Crude benchmarks moved upward and gasoline futures followed. In several U.S. regions, retail gas prices rose overnight, driven by concerns about tighter supply and higher replacement costs. Analysts warn that price sensitivity is especially high when inventories are already under pressure. The timing matters. Global oil markets are operating with limited spare capacity. Production growth has struggled to keep pace with demand in several regions. Any redirection of supply, even if planned, can feel abrupt when buffers are thin. This could mean continued volatility in fuel prices over the coming days. Canada has framed the move as a diversification strategy. Relying too heavily on a single export destination carries risk. By expanding access to Asian markets, Canada strengthens its negotiating position and reduces dependence on any one buyer. This approach aligns with broader global trends as countries seek flexibility in an uncertain energy landscape. For the United States, the impact is immediate and uncomfortable. While domestic oil production remains high, not all crude is interchangeable. Refineries are designed for specific grades of oil. Canadian crude fits many U.S. facilities particularly well. Replacing it often requires sourcing from farther away or making technical adjustments, both of which increase costs. Gas prices respond not just to supply but to expectations. When traders believe supplies may tighten, prices move before shortages appear. This is what drivers are seeing now. Even if overall supply remains adequate, the perception of reduced access pushes prices higher. Transportation adds another layer. Oil redirected to Asia must travel longer distances by sea. This increases shipping demand and costs. Higher shipping rates feed back into global oil prices, affecting markets far beyond Canada and China. Analysts warn that these logistics effects are often underestimated. There are also implications for natural gas markets. Energy systems are interconnected. When oil flows shift, refineries and power producers adjust fuel mixes. Increased competition for certain energy sources can push gas prices higher as well. In some regions, natural gas prices rose alongside gasoline overnight. The broader context is global competition for resources. Energy is not just an economic commodity but a strategic asset. Securing supply influences national security, industrial stability, and political leverage. Canada and China's coordination signals how energy relationships are becoming more global and less predictable. U.S. businesses are paying close attention. Transportation companies, airlines, manufacturers, and farmers all depend on stable fuel costs. Sudden increases squeeze margins and complicate planning. Analysts warn that prolonged volatility can slow investment and raise consumer prices across the economy. Consumers feel the impact most directly at the pump. For many households, fuel costs are a daily expense that cannot be easily reduced. Even small increases add up over time. When prices jump overnight, it creates frustration and uncertainty, especially when causes feel distant and complex. The situation also highlights infrastructure constraints. Pipeline capacity, port access, and refinery flexibility determine how quickly markets can adapt. While the United States has significant energy infrastructure, much of it is optimized for existing trade patterns. Rapid changes expose rigidity in the system. Canada's decision does not mean an end to energy trade with the United States. Large volumes will continue to flow. However, the shift sends a clear signal that alternatives are active and growing. This could mean future negotiations happen on different terms. China benefits from the perception of momentum. Securing energy from a stable supplier like Canada reduces exposure to geopolitical risk elsewhere. It also strengthens China's position in global energy markets, where long-term contracts often matter more than spot prices. Environmental considerations are also part of the discussion. Longer shipping routes increase emissions. At the same time, energy security concerns often override environmental priorities in the short term. Analysts warn that balancing climate goals with energy needs remains a major challenge. Markets will watch closely to see if this redirection is expanded. If additional volumes are diverted, the impact could grow. If the shift remains limited, prices may stabilize. Much depends on how other producers respond and whether demand changes. Diplomatic channels remain active. Energy trade has always been intertwined with politics, but it is also driven by contracts and infrastructure realities. Adjustments made today can lock in patterns for years. This could mean the current move has lasting influence beyond immediate price spikes. For the United States, the moment raises questions about energy resilience. Diversifying supply, increasing flexibility, and managing infrastructure constraints may become higher priorities. Analysts warn that assuming stable access is no longer enough in a rapidly changing global market. For Canada, the challenge will be managing multiple major partners with competing interests. Diversification brings opportunity, but it also requires careful balance to avoid long-term friction. As prices continue to fluctuate, drivers and businesses are left reacting in real time to decisions made far from gas stations and highways. Energy markets move quickly, and their effects are felt immediately. And the question for viewers tonight is this: as global energy flows shift and alliances evolve, how can countries protect their own stability without creating sudden shocks for the people who depend on affordable fuel every day? The ripple effects from this energy shift continue to spread across markets, supply chains, and household budgets. What began as a redirection of oil cargoes is now influencing broader expectations about trade reliability and long-term partnerships. Energy buyers are recalculating risk, sellers are reassessing leverage, and consumers are caught in the middle of forces far beyond their control. In the United States, refiners are adjusting procurement plans on the fly. Facilities that relied heavily on Canadian crude are seeking replacement barrels from other regions, including offshore suppliers. These alternatives often come with higher transportation costs and longer delivery times. Even when supply is secured, the added expense feeds into refined fuel prices, pushing costs higher for distributors and retailers. Energy analysts warn that such adjustments rarely happen smoothly. Contracts must be renegotiated, shipping schedules rearranged, and quality differences managed. Each step introduces uncertainty. This could mean price swings continue even if overall global production remains stable. Canada's position in this moment is complex. On one hand, expanded access to Asian markets offers stronger bargaining power and reduced dependence on a single customer. On the other hand, maintaining balance with long-standing partners requires careful signaling. Energy trade is built on trust as much as infrastructure. Sudden changes, even if commercially justified, can reshape perceptions for years. China's involvement adds another layer. By absorbing redirected oil volumes, China strengthens its energy security while signaling its readiness to engage with suppliers outside traditional routes. This move aligns with a broader strategy of securing long-term resources to support industrial growth and economic stability. It also positions China as a central player in determining future energy flows. The global shipping industry is already reacting. Increased demand for long-haul tanker routes is pushing freight rates higher. These costs are embedded in oil prices, amplifying their impact. This could mean even regions not directly involved in the Canada-China arrangement feel the effects through higher energy-linked expenses. Natural gas markets are also watching closely. While oil and gas are distinct commodities, they influence each other through power generation and industrial use. When oil prices rise, some sectors shift demand toward gas, tightening those markets as well. Analysts warn that such cross-market pressures can magnify volatility. For businesses in the United States, planning has become more difficult. Transportation firms face higher fuel bills, manufacturers see rising input costs, and retailers anticipate pressure on consumer spending. These effects do not appear all at once. They accumulate gradually, often surfacing weeks or months after the initial shock. Households experience the impact more directly. Fuel costs influence commuting, food prices, and heating expenses. When prices rise unexpectedly, families have little time to adjust. This creates stress and uncertainty, especially in regions where alternatives to driving are limited. The energy shift also raises questions about infrastructure investment. Pipelines, ports, and refineries are expensive and long-term assets. When trade patterns change, some infrastructure becomes underutilized while other routes face congestion. This could mean future investment decisions will prioritize flexibility over efficiency. Environmental considerations remain in the background but cannot be ignored. Longer transport routes increase emissions, and higher prices can slow transitions to cleaner energy if consumers focus on immediate affordability. Analysts warn that energy insecurity often delays environmental progress rather than accelerating it. From a geopolitical perspective, the move underscores how economic decisions can carry strategic weight. Energy trade shapes alliances, influences negotiations, and affects national confidence. Countries that control supply routes or volumes gain leverage, even without explicit political intent. The United States still holds significant advantages, including domestic production and technological capacity. However, this moment highlights vulnerabilities tied to specialization and interdependence. Relying on specific grades of oil or fixed supply routes limits adaptability when conditions change. Canada's diversification strategy may encourage other producers to explore similar options. If more exporters seek alternative markets, global trade flows could become less predictable. This could mean increased competition, higher baseline prices, and more frequent disruptions. China's growing role as a destination for redirected energy reinforces its influence on global pricing. When large buyers commit to long-term contracts, they shape expectations and investment decisions worldwide. Producers respond to demand signals that promise stability, even if they alter existing relationships. Market sentiment remains fragile. Traders are watching inventory data, shipping movements, and policy signals for clues about next steps. Even small developments can trigger price reactions in an environment already sensitive to change. For policymakers, the challenge lies in balancing market forces with public impact. Sudden fuel price increases attract attention and concern, yet energy markets operate globally, often beyond the reach of immediate intervention. This could mean future strategies focus more on resilience than control. Energy resilience includes diversified supply, flexible infrastructure, and transparent communication. Without these, sudden shifts can feel like shocks rather than adjustments. Analysts warn that resilience takes years to build but can be tested in days. As the situation evolves, the broader lesson may be about interconnectedness. Decisions made in one part of the world now reverberate quickly across oceans and economies. Energy, once seen as a stable backbone, is increasingly dynamic and responsive to global strategy. Consumers, businesses, and governments are all adjusting in real time. The redirection of oil has become more than a trade story. It is a reminder of how tightly linked modern economies are to energy flows, and as prices fluctuate and alliances adapt, one question remains for viewers. In a world where energy routes can shift overnight, how should countries and citizens prepare for a future where stability is no longer guaranteed?